Imagine spending millions of dollars on a business you would later call one of the biggest mistakes of your life. Most people would spend years trying to hide that decision. Warren Buffett did the opposite. He spoke about it openly. He analyzed it. He learned from it. And somehow, that very mistake became the foundation of one of the greatest business empires in American history. Today, Berkshire Hathaway is worth hundreds of billions of dollars and owns or holds major interests in companies that touch the daily lives of millions of people, from insurance and railroads to energy, manufacturing, and consumer brands. But none of that was the original plan. It began with a struggling textile mill in New England, a disagreement over a stock buyback, and a decision driven as much by emotion as by logic. This isn't simply the story of how Warren Buffett became one of the world's most respected investors. It's the story of why one of his rare mistakes ultimately became his greatest platform for creating long-term value. And along the way, it reveals a lesson that challenges one of the biggest myths in business. Sometimes success doesn't come from avoiding mistakes. It comes from knowing what to do after you've made one. Long before Warren Buffett became known as the Oracle of Omaha, he was a young investor obsessed with numbers. As a child, he delivered newspapers, sold chewing gum, and studied businesses with unusual curiosity. While many children spent their free time playing games, Buffett spent his reading annual reports, financial statements, and investment books. He wasn't fascinated by luxury. He was fascinated by value. One book, The Intelligent Investor by Benjamin Graham, would shape his thinking for decades. Graham taught that markets often misprice businesses, creating opportunities for patient investors willing to think independently. That philosophy became Buffett's foundation. Buy businesses for less than they're worth. Ignore short-term market emotion. Think like an owner, not a trader. Those principles helped Buffett build an impressive investment partnership during the 1950s and early 1960s. By his early 30s, he had already earned a reputation for disciplined investing. Yet the opportunity that would define his career wasn't a promising technology company. It wasn't a revolutionary invention. It wasn't even a growing business. It was an aging textile manufacturer whose best years appeared to be behind it. Berkshire Hathaway wasn't born as an investment giant. It was a textile company operating in an industry facing relentless competitive pressure. For decades, textile manufacturers in the northeastern United States had struggled against lower-cost producers elsewhere. Margins shrank. Competition intensified. Factories closed. Many investors viewed companies like Berkshire Hathaway as yesterday's businesses. To Buffett, however, something else stood out. The company's assets appeared to be worth more than the market price of its stock. This was exactly the kind of situation Benjamin Graham had taught his students to investigate. Buffett didn't believe Berkshire would become a great textile business. He believed it might simply be an undervalued investment. If management continued buying back shares at attractive prices, he expected to make a reasonable profit and move on. At least, that was the original idea. Then something unexpected happened. According to Buffett's own account, Berkshire's management indicated they would repurchase his shares at a certain price. When the formal offer arrived, the price was slightly lower than what he believed had been discussed. The difference wasn't enormous. But to Buffett, it represented something more important than money. It represented trust. Feeling frustrated by what he viewed as an unfair change, he made a decision that would alter the course of business history. Instead of selling his shares, he began buying more. Eventually, he accumulated enough ownership to gain control of the company. From a purely emotional perspective, the decision may have felt justified. From a capital allocation perspective, Buffett would later say it was a mistake. Years afterward, he reflected that if he had invested the same money directly into better businesses instead of taking control of a struggling textile manufacturer, the financial outcome could have been even greater. Yet history rarely follows a straight line. Because once Buffett owned Berkshire Hathaway, he faced a new challenge. He now controlled a business trapped in a declining industry. Walking away was no longer an option. He had to decide what Berkshire Hathaway would become. and that decision would quietly reshape American business for generations. The textile mills continued to struggle. The economics refused to improve. But Warren Buffett wasn't interested in preserving the past. He was beginning to imagine something entirely different. Instead of trying to build a better textile company, what if Berkshire Hathaway became a vehicle for owning extraordinary businesses? That single shift in thinking would transform an ordinary manufacturing company into one of the most influential business empires in history. And it all started with a mistake that Buffett never tried to erase. Owning Berkshire Hathaway presented Warren Buffett with a difficult reality. The textile mills continued operating, but the economics were getting worse. Competition from lower-cost producers kept increasing. Margins remained thin. Every dollar invested into modernizing the mills produced smaller and smaller returns. This wasn't simply a management problem. It was an industry problem. Buffett understood a lesson that many executives struggled to accept. A great manager cannot permanently overcome a fundamentally weak business. He could continue pouring money into textile factories, or he could redirect Berkshire's capital toward businesses with stronger economics. That decision would redefine the company forever. Instead of asking, "How do we save this textile business?" Buffett began asking, "Where can every extra dollar earn the highest long-term return?" That subtle shift changed everything. Berkshire Hathaway stopped thinking like a textile manufacturer. It started thinking like a capital allocator. That distinction became its greatest competitive advantage. It was cash. More specifically, cash that arrived before expenses had to be paid. That discovery came through insurance. To many people, insurance seems ordinary. People pay premiums. Companies pay claims. Business continues. But Buffett saw something deeper. When an insurance company collects premiums today, it often doesn't pay claims until months, or even years, later. During that time, the company temporarily controls money that belongs to policyholders. In the insurance industry, this pool of money is called float. Most companies treat float as a liability that must be managed carefully. Buffett agreed, but he also recognized something extraordinary. If an insurance business is run responsibly, that float can provide a large source of investable capital before claims are due. In other words, Berkshire wasn't just earning profits from insurance operations. It also had access to substantial capital that could be invested into other businesses while maintaining the ability to meet future obligations. This wasn't free money. It came with responsibilities and risk. But when managed conservatively, it became one of Berkshire Hathaway's defining strengths. Over time, insurance operations, including companies such as Geico and National Indemnity, helped provide Berkshire with capital that Buffett could allocate across a growing portfolio of businesses and investments. The textile mills had limited Berkshire's future. Insurance expanded it. Start buying great companies. Early in his career, Buffett followed many of Benjamin Graham's principles. He searched for statistically cheap businesses, undervalued assets, bargains. Sometimes those investments worked remarkably well. But experience taught him something Graham's framework couldn't fully explain. Buying a mediocre company at a very low price often created only temporary success. Eventually, the underlying business problems returned. The real breakthrough came when Buffett increasingly embraced the idea that paying a fair price for an outstanding business could be better than paying a bargain price for a weak one. He later credited this evolution in thinking in part to Charlie Munger, his longtime business partner, who encouraged him to look beyond simple bargains and focus more on exceptional businesses with durable competitive advantages. That insight changed Berkshire's future. Instead of asking, "What's the cheapest company?" Buffett began asking, "Which businesses will still be exceptional 20 or 30 years from now?" That single question reshaped every major acquisition that followed. As Berkshire evolved, its acquisitions reflected a remarkably consistent philosophy. Not businesses that were fashionable. Not companies dominating the headlines. Not speculative opportunities built on excitement alone. Instead, Buffett preferred businesses with characteristics he believed could endure. Products or services people would continue needing, capable and trustworthy managers, strong financial performance, reasonable levels of debt, business models he could understand. Most importantly, he avoided investing in companies simply because everyone else was doing so. He often explained that he preferred staying within his circle of competence. If he didn't understand how a business made money or what might threaten it in the future, he was comfortable saying no. That discipline often meant missing popular trends. But it also helped Berkshire avoid many investments that later disappointed the market. Over time, Berkshire acquired or built significant positions in companies spanning insurance, railroads, manufacturing, energy, consumer goods, and other sectors. The common thread wasn't the industry. It was the quality of the business and the discipline behind the decision. Unlike many global corporations, Berkshire Hathaway rarely promoted itself with flashy advertising or celebrity branding. There was no grand headquarters dominating television commercials. No dramatic product launches. No marketing campaigns celebrating its success. Yet quietly, year after year, Berkshire's influence expanded. Its subsidiaries employed hundreds of thousands of people. Its investments touched transportation, housing, retail, manufacturing, utilities, finance, and countless everyday products and services. Most Americans interacted with businesses connected to Berkshire without realizing it. That quiet expansion reflected Buffett's philosophy. He wasn't trying to build the most famous company. He wanted to build one of the strongest. The headlines often celebrated bold announcements. Berkshire focused on patient execution. The market often chased rapid growth. Berkshire emphasized disciplined capital allocation. The difference wasn't always exciting. But over decades, it proved extraordinarily effective. By now, Berkshire Hathaway had become far more than the struggling textile company Buffett once considered a mistake. The mills that gave the company its name were fading into history. In their place stood a growing collection of businesses connected by one simple principle: allocate capital wisely. But success created a new challenge. As Buffett's reputation grew, so did expectations. Investors wanted to know whether his methods could continue working in a changing world. Could patience still outperform speed? Could discipline still beat excitement? The next chapter would test those questions and reveal why Berkshire Hathaway's greatest strength was never simply its investments, but the mindset behind them. As Berkshire Hathaway grew, many people assumed Warren Buffett possessed a secret formula for finding extraordinary investments. The reality was less mysterious and far more difficult. His greatest strength wasn't saying yes. It was saying no. No to businesses he didn't understand. No to fashionable investments driven by excitement instead of fundamentals. No to opportunities that required predicting the unpredictable. In an era when many investors believed success came from moving faster than everyone else, Buffett often did the opposite. He waited. Sometimes for months. Sometimes for years. He often explained that there was no prize for being the busiest investor. There was only a reward for making sound decisions when genuine opportunities appeared. Patience wasn't inactivity. It was discipline. That distinction separated Berkshire Hathaway from much of Wall Street. Many investment firms are judged quarter by quarter. Buffett focused on decades. The result was a culture that valued thoughtful decision-making over constant activity. Most people think of the stock market as a place where prices rise and fall every day. To Buffett, those changing prices were only part of the story. Behind every stock symbol was a real business. Employees, customers, products, factories, management teams, cash flows, competitive challenges. He believed that if you wouldn't feel comfortable owning an entire business, you shouldn't be eager to own a small piece of it through the stock market. That perspective changed everything. Instead of asking, "What will this stock do next month?" he asked, "Will this business still be stronger 10 or 20 years from now?" That mindset removed much of the emotional noise surrounding investing. Market declines became opportunities to evaluate quality rather than reasons to panic. Rising prices alone were never enough to justify an investment. For Buffett, value came first. Price came second. The true strength of an investment philosophy isn't revealed during easy times. It's tested during uncertainty. Over the decades, Berkshire Hathaway faced recessions, market crashes, financial crises, inflation, and periods when fear dominated the headlines. Each crisis presented the same question. Would Buffett abandon the principles that had guided him for years? Again and again, he remained remarkably consistent. That didn't mean every investment succeeded. No investor is right all the time. Instead, Buffett focused on maintaining a process rather than chasing perfect outcomes. One of the most well-known examples came during the financial crisis of 2008. As confidence in major financial institutions weakened and markets experienced extraordinary volatility, Berkshire invested in several large American companies under negotiated terms. Those decisions reflected Buffett's willingness to act when others were pulling back, provided he believed the underlying businesses remained fundamentally sound and the terms made sense. His actions weren't based on optimism alone. They were based on preparation. Years of conservative financial management gave Berkshire flexibility when opportunities emerged. That may be one of the company's greatest competitive advantages. Not predicting every crisis, but being financially prepared when crises arrived. No story about Berkshire Hathaway is complete without Charlie Munger. Although Warren Buffett became the public face of the company, Munger played an essential role in shaping its long-term direction. Munger challenged Buffett to expand beyond searching only for statistically cheap companies. He encouraged a greater focus on exceptional businesses with durable competitive advantages, capable management, and long-term earning power. Rather than buying average businesses simply because they appeared inexpensive, Berkshire increasingly sought businesses whose quality justified patient ownership. The two men didn't always agree immediately. They debated ideas, tested assumptions, questioned each other's reasoning. That intellectual partnership strengthened Berkshire's decision-making. It demonstrated an important principle. Great leaders don't surround themselves with people who always agree. They seek thoughtful disagreement grounded in evidence. The goal isn't to win an argument. It's to make a better decision. That culture of rational discussion became one of Berkshire Hathaway's defining characteristics. Unlike many corporations, Berkshire Hathaway operates with an unusual degree of decentralization. Many of its subsidiaries continue running their day-to-day operations independently. Managers are expected to think like owners. Responsibility is paired with trust. Rather than building layer upon layer of bureaucracy, Berkshire often keeps its corporate headquarters remarkably lean. This approach reflects Buffett's belief that talented managers perform best when given both accountability and autonomy. It also reduces unnecessary complexity. While many organizations grow by adding more rules, more approvals, and more management levels, Berkshire has often favored simplicity where possible. That doesn't eliminate risk, but it encourages long-term thinking and clear responsibility. Culture, not just capital, became one of Berkshire's most valuable assets. By now, the struggling textile company Buffett once regretted buying had become something entirely different. A collection of businesses. A disciplined investment philosophy. A culture built on trust, patience, rational thinking, and careful capital allocation. Yet perhaps the most remarkable part of the story wasn't the size of Berkshire Hathaway. It was the lesson hidden inside its unlikely beginning. Because the investment Buffett called a mistake didn't become successful by accident. It became successful because he refused to let a mistake define the future. Instead, he adapted. He learned. He changed course. And in doing so, transformed one of American business history's most unexpected acquisitions into an enduring enterprise. But what, exactly, can entrepreneurs, investors, and business leaders learn from that journey? The final chapter isn't about Warren Buffett's wealth. It's about the principles that continue to influence generations of decision-makers, and why they matter far beyond the world of investing. Most great companies eventually become inseparable from the personality of the person who built them. But the greatest organizations are designed to survive long after their founders are gone. That has always been one of Warren Buffett's greatest challenges. Not building Berkshire Hathaway, but ensuring Berkshire Hathaway could continue without him. For decades, Buffett repeatedly reminded shareholders that a company should never depend entirely on one individual. Its strength must come from its culture, its principles, its discipline, its people. This philosophy shaped Berkshire's leadership approach. Rather than chasing dramatic reinventions, the company focused on preserving the investment discipline and decentralized management style that had guided it for generations. The goal was never to create another Warren Buffett. The goal was to build an institution capable of making sound decisions long after any single leader stepped aside. History suggests that enduring organizations are rarely defined by charisma alone. They're defined by systems. And Berkshire Hathaway became one of the clearest examples of that principle. At first glance, Warren Buffett's journey appears to be a story about investing. But beneath the financial headlines lies something far more universal. It's a story about decision-making, about discipline, about learning, about adapting when reality changes. The purchase of Berkshire Hathaway could have remained exactly what Buffett later called it: a costly mistake. Instead, it became the foundation for a completely different vision. Not because the original decision was perfect, but because the decisions that followed were wiser. That distinction matters. Many people spend years trying to avoid mistakes. The greatest business leaders often become exceptional because they learn faster than others once mistakes happen. Buffett didn't pretend the textile business would suddenly become a thriving industry. He accepted reality. He redirected capital. He adjusted his strategy. He focused on long-term value rather than defending an old idea. That willingness to change course may have been the most valuable investment he ever made. Every remarkable business story leaves behind principles that extend far beyond boardrooms and balance sheets. Here are 4 lessons drawn from Warren Buffett's Berkshire Hathaway journey. Lesson 1. Separate your ego from your decisions. Many people continue investing time, money, or energy into failing ideas simply because admitting a mistake feels uncomfortable. Buffett publicly acknowledged that buying Berkshire Hathaway's textile business was not his finest investment. Recognizing that reality gave him the freedom to build something better. Humility can become a strategic advantage. Lesson 2. Capital is valuable. How you allocate it matters even more. Money alone doesn't create extraordinary businesses. The discipline to invest resources where they generate lasting value often matters more than the amount available. Throughout Berkshire's history, thoughtful capital allocation became one of its defining strengths. Every dollar had a purpose. Every investment had to earn its place. Patience is not passive. Modern business often celebrates speed, but speed without direction can destroy value. Buffett demonstrated that disciplined patience isn't about doing nothing. It's about waiting until the right opportunity aligns with sound judgment. That distinction shaped decades of Berkshire Hathaway's growth. Build systems that outlast individuals. Whether leading a small business or a global organization, lasting success depends on creating principles and structures that survive beyond any one person's leadership. Institutions endure when their culture is stronger than their personalities. That may be Berkshire Hathaway's greatest legacy. People often ask, what was the single decision that built Warren Buffett's empire? It wasn't simply buying Berkshire Hathaway. And it wasn't finding one perfect investment. The defining decision came later. It was choosing to transform a struggling company into a disciplined capital allocation machine. It was replacing attachment with adaptation. Replacing emotion with reason. Replacing short-term thinking with decades-long perspective. History remembers Berkshire Hathaway because Warren Buffett didn't remain trapped by the original investment. He reimagined what the company could become. Sometimes the decision that changes history isn't the first one you make. It's the one you make after discovering the first was imperfect. Every iconic business has a defining moment. A choice that seems ordinary at the time. A decision that, years later, becomes the turning point everyone remembers. Warren Buffett's story reminds us that remarkable success isn't built on flawless judgment. It's built on continuous learning, disciplined thinking, and the courage to adapt when circumstances change. The next great business story isn't only hidden inside boardrooms or billion-dollar deals. It's hidden inside the decisions people make every day, often long before anyone notices their significance. And that's exactly what we'll continue exploring here on Billionaire Realm. Not just the fortunes that shaped history, but the choices that made those fortunes possible. Because behind every empire, there's always a decision worth understanding. If you enjoyed this documentary, subscribe to Billionaire Realm for thoughtful, research-driven stories about the defining decisions, pivotal mistakes, and timeless strategies that shaped the world's greatest business empires. Next documentary: The Decision That Made Sam Walton America's Retail King. Until next time, keep questioning the stories behind success.